Hello, Smart Money Tree Podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. I'm once again joined with my good friend Doug Heagren. Hey, Doug.
Hey, Kirk. Good morning. How are you doing today?
Good, good. Glad to have you back. Doug was on
Thank
a
you.
hiatus. He was traveling around the world, or at least New England and parts of Canada, and it was a nice break for Doug. So, what'd you do, Doug?
Well, we decided to cram everybody into a car, although we got a bigger car for this trip, and decided to take it and drive from Minnesota, where I'm based. Which I heard there's we've talked about Minnesota a few times on the show. I'm not going to go there, today. And we ended up going to your neck of the woods, Kirk, and got to hang out with you, which was nice. We ended up driving all the way to the coast and going up through Newport, Boston, Maine, and then eventually kind of after staying there a few days, went into Montreal, down through Toronto, down through Michigan, Ontario to we did go to Niagara Falls, into the Michigan, back to that. So I mean, all in all, we put about 3,900 miles. I think I turned the car that had 6 miles on it when we rented it, and I turned it in with about 4,500 miles on it at the end of the day. But what was interesting, and I thought this would be interesting for you, we talk about the way we view things here versus the way the rest of the world views things, is we actually stayed at a place in Montreal, and the woman that owned the place popped over. I was telling you a little bit about this earlier. Popped over a little, it's a Verbo we're renting. Probably don't want to see the owner. Popped in a little more than we'd like to see. But then she also proceeded to, without inquiry, proceed to tell us all the wonderful things about the system in Canada, and how she spends 6 months of her year paying taxes. She gets to keep the other 6 months of the year is her money. But you know how great it is, that she gets to give up this money to the Canadian government and be able to help all those other people. And she loves paying her taxes so that all the people in Canada can be supported, through their healthcare programs. And of course, we don't have the guns here. We don't shoot everybody like you do down in the States. Very interesting. Like I said, I'm not an opinion on either one of these things about whether it's right or wrong. I know we got listeners that would probably love to have universal health care, and we have listeners here who are very much happy with, or probably nobody's happy with the system we have entirely, but prefer it over the alternative. But it was interesting to be in Canada and have an unsolicited diatribe about how great their system is compared to ours. So, listen, one thing I will give Canadians, they, just like Americans, they're very, very proud of their country. And she was very happy to tell me all the reasons she was proud of it. So it was nice. It was a nice cultural lesson.
Nice.
Sure.
That's great, Doug. That's the one thing you say about Canada is the people are just nice. Like,
Yeah.
nicest people in the world. I don't know about the world, but they're some of the nicest people I ever meet are Canadians.
Yep.
And it's funny when we make fun of Canadians because we're Americans and they're our neighbors, so we can do that. But outside of paying for police to stop trucking convoys, I mean that's a high tax rate. And
Yep.
we don't have a tax rate that's that high in this country unless you're in the highest tax bracket.
Yep.
And you know, I think what's funny, and I just want to, I'm going to say this and move on because we'll start a political debate, and I don't want to do that. When you think about the taxes, I, I've always thought about this as a very interesting concept, right? So we started with the income tax back in the early 1900s, and it started with it's only going to be for the rich people.
Mm-hmm.
That's how they got it through. Because before that, we were not paying tax on income. It was
Yes.
basically consumption tax, and
Yep.
the various taxes, but it wasn't on income. And at the time, they said, "Oh, it'll just be on the wealthiest people." Oh, okay, sure. Everyone voted for it because it's only for the wealthiest. And then slowly it creeps down. Now it impacts everybody. And
Mm-hmm.
there are some good and some bad parts about it. There are some people that hate taxes, never want to pay them. I get that, right? I totally get it. It feels bad that the government is taking my money and using it for things I don't agree with, right? I think we can all say that. They're using it for stuff we don't agree with. I think that's
Mm-hmm.
that's a blanket statement. So I think it's a hard pill to swallow for people to want to pay taxes for things that they don't agree with or that they don't want and or that the government's paying 10 times as much for, right?
Yes.
I don't think there are any like $20,000 toilets in Home Depot, but for some reason the government finds a way to pay 20 grand for a toilet. So, when you have things like that, it just makes it really hard to stomach paying taxes. But what's interesting is, if you think about it, right now the U.S. government via the Fed is effectively printing money. They're not currently, and I want to state this, but let's move it back, a year, 2 years ago. They were
Mhm.
effectively printing money. They've been printing money for the last 100 years, right? So they're printing money, and you think about it, it's like, all right, they can print as much as they want because we're the world's reserve currency, right? No other country in the world can do this. We're the only country in the world that can print as much money as we want, and no one can say anything about it, right? And it doesn't impact us in the same way as everyone else. So because of that, it makes me wonder, why are we paying taxes at all? Why don't they just print more money? I mean, that's a legitimate question to ask, because if effectively they're asking us for a piece of our income and they're going to use it in ways that we don't agree with,
Yeah.
why don't they just print the money themselves? Because you're already getting the same impact. You're getting high inflation. They're going to use it right now. I think, what is it? 40% of the GDP is made up of government.
Yeah,
We want to
absolutely.
talk about why all the numbers are screwy in the last few decades, because the government is basically manipulating the GDP data, because they're never going to stop spending. So
Mhm.
we'll never go into a government recession if 40% of the GDP of the US is spent by the government. They're never going to stop spending. So effectively, if you only got 60% of the country that either goes through a recession or not, so you're like, oh, it was only a slight recession. Well, it's probably double that, because, if you take out the government piece. But we get into this like fun with numbers concept when you look at all these aspects of just raising a question. Why do we even pay taxes at all? And the conservatives are like, yeah, we don't want to pay taxes, and the liberals are like, you should pay the taxes, you should pay your fair share, and tax the wealthy, and all the stuff they say. It's like, why does anybody pay taxes? Like, why don't we just print the money? And then you can give it to whoever you want, because they're doing that anyway, right? So I'm not saying it's the right approach. I want to be very clear. What I'm saying is a thought experiment. It is not the right approach. It is not. I'm not, saying this is the best way to do it. No, I'm saying it's a thought experiment. Think about it. What would happen if no one paid taxes and the government just printed money to cover the deficit, which they've had for decades now? They always run a deficit. So they're printing money anyway. So why not just print more of it? What's the worst thing that could happen? Well, you say hyperinflation. Yeah, you mean like the situation we're in now? Like, we're not in hyperinflation, but they're printing a huge amount of money and we're not paying it back to anybody. And it's the same problem over and over. But if you took away the tax for everybody, people would generally spend more because they'll have more in their pocket to spend. You can say,
Mhm.
well, the wealthy aren't going to spend more. Yeah, that's true. But the wealthy make up 1% of 1% of the population. The rest of the population that has a third or half of their money taken out of their payroll, they're going to spend that money. They're going to buy more. They're the ones that are going to push the economy forward. So I use it as a thought experiment, because I think we all make a lot of assumptions in our daily lives, whether it's finance, personal finance, investments, or the economy, that we just make assumptions. Oh, it's always been this way, so it should be this way. Or worse yet, we think, uh, someone else probably is smarter about this than me, right? And it's possible, right? It's possible there's somebody smarter, or it could be because it's happened for so many years that it's not going to stop happening. Look at the food pyramid. The
Mm.
food pyramid was pretty much, disregarded over a decade ago, and people still use it. It's still in the government flyers. They never bothered to update it.
Mhm.
And if anything, it's inverted. And a lot of scientists are coming out now and saying that actually, it should be this way and this way. It basically came out because it was the lobbyists said you need to have more corn, you need to have more grains. It was basically a lobbyist propaganda. Is basically what it was. It was a commercial for people to eat more grains and all the things with the lobbyists came. And I'm not saying it's bad, because it's part of the economy and it's how our economy runs. You have lobbyists doing these things. We could argue whether it's right or wrong, but the point is it's already come. People have already come out and said this is not true, and they're still using it. So always have to look at the assumptions we're making. Are they true assumptions? Like, we look at the global financial crisis in 2008, and people say, well, it's pretty obvious that the efficient market theory is no longer valid. I think everybody agrees that it's no longer valid. Doesn't mean it's a bad theory. Just means that it's not valid, because clearly people don't always have all the information at the same time, and they're not always acting in their own best interest, and all these other things that are part of that assumption.
Mm.
So you should always assess your assumptions and say, huh, that's interesting. Why are we paying taxes? Let's figure it out. Let's read up on it. Like, let's look and say, why did this happen? What does it do? And is it possible we could not do it? If we did that with our whole economic system and government, I think we'd find a lot better solutions. So I'll give you another example, and I'm gonna I'm gonna really fight myself in the fact that I'm even going to say this because I'm going to dip into politics. But you look at some of these states or cities that are saying, like ban the police, or the police are bad, or we're gonna defund the police, or whatever that flavor of thinking is, right? You say, okay, you should try that. I don't want to live there, right? If you want to try that as an experiment in your city, you should try it and let's see what happens in a year or two, right? If you're right and your crime goes way down, then you were correct. If it finds out that you turn into a flaming cesspit, then obviously you're incorrect and we should never ever try that again, right? So if you think about like how to think about these things, like we start with thought experiments, right? It's a lot of finance and investing and I guess you call it creative finance in many ways. It starts with a thought experiment. Huh, what if we did it this way? What if we tried it this way? I'm totally for thought experiments. We should be thinking outside the box. And in many ways, we should be trying these little experiments. We shouldn't say the whole country should go to a flat tax. No, that's stupid. What we should say is let's take one small area, let's take a city, try it out, see what happens. See if it's a good or a bad thing. If it turns into a good thing, let's expand it, try a few more cities. Because you can't just take one city and say it's fact, because there could be other things going on in that city that have nothing to do with this, right? So try to expand it a little bit more until it becomes more widespread. That's the right way to implement new policy. It's not like, hey, let's do this thing and let's mass adoption everywhere right away, which causes a lot of unintended consequences, as we all know. We've seen that time and time again in politics. So I think it's a great idea to do stuff like that. So, like I said, I don't agree with, defunding the police and all that, because I think it's stupid. Like, we pay the police to protect us, and yes, they might be biased towards some groups and not. It's not my experience, so I can't comment on other people's experience. But what I will say is, as a theory, it's a bad idea, right? Because people take advantage of crime, just like in California, where people rob convenience stores because they can, because they won't get arrested if you take less than $1,000. Another stupid idea, in my opinion. But if you want to try it, try it. Let's see what happens. When all the retail stores leave your state because they're losing money, then you're going to find out it was a bad idea, right? So I think, this is how we should think about everything: is start with a thought experiment, try it in a small experiment, something that's not harmless, but like as harmless as you can get in a small place. And then if it works, expand it. If it doesn't work, stop doing it altogether. So I wanted to start with that because I thought it was, as we think about these different concepts like taxes, you really should think about, you shouldn't just take your partisan opinion of more taxes or less taxes, but actually think about it. Like, how does this work? Like, because the other thing I'll say on taxes, and we'll move on to Doug, because I don't really want to get into politics, is, what's the purpose of taxes? And I'm going to take the other side of my opinion because I don't want people to think I'm against taxes. What's the purpose of taxes? Well, one of the purposes of taxes that I'm surprised no politician ever talks about, one of the purposes of taxes is incentivizing behavior. Okay? Incentivizing behavior. So let's take real estate. Real estate is one of the best asset classes out there because it has a lot of incentives, a lot of tax benefits in real estate that you don't get in owning a publicly traded stock, right? You get depreciation, you get write-offs, you get all these things that happen in real estate you can't get in other asset classes, right? So, but why is that the case? Because the politicians are trying to incentivize you to own real estate, which supports the value of real estate. So the reason we have so many ultra wealthy people who own real estate is because of the tax incentives. And they're going to keep owning it, and that's going to incentivize people to own real estate, which supports the prices and all the positive things that come along with that. So taxes allows that to happen. If you didn't have any taxes, you wouldn't have those incentives. You wouldn't have the incentives to, let's say, R&D tax credits, right? To help R&D in this country, or manufacturing, or all these other things that come in, like drilling for oil. There's a lot of tax benefits that come and credits that come for drilling for oil and gas. Those wouldn't exist if we didn't have taxes. So the point I'm saying is you have to look at all sides of it and analyze and say, is my thinking correct, or am I thinking it totally wrong, right? And you have to be honest with yourself, because our ego won't allow us to be wrong. Any one of us, right? That's how we're wired. We don't want to be wrong. So you have to kind of pull yourself out of the ego aspect of it and say, yeah, my opinion is probably wrong, and I'm okay with that. Okay, great. But if you can't step back from your thinking and realize that I could be wrong, then you're probably missing a big piece of the analysis. And I'm using this as an overlay for how to think about everything when it comes to investing. You have to be able to think differently. You have to be able to pull your ego out of the equation if you want to be successful. Because if it's all about ego, then you're going to lose more than you're going to win. Because the smartest and best investors of all time make mistakes. And the reason they're successful is because they acknowledge the mistakes and move on. They don't dwell on it. They don't try to make it back. All of the cognitive dissonance, the cognitive biases that we have, all of these things come from not being able to be honest with yourself.
This is a public service announcement. Have you ever played the lottery? My state advertises that you can't win if you don't play. What they don't tell you is that the lottery is a tax on people who are bad at math. How many lottery winners have you met? Probably none. If you don't like your chances of winning the state lottery, you're definitely not going to like the chances of winning the inflationary lottery. The inflationary lottery? That's right. Your chances to win the state lottery might be 1 million to 1. But you're guaranteed to win the inflation lottery because it affects everyone. And the prizes stink. But here's what you're going to win. Higher prices at the store, shrinkflation in your packaged goods. Higher heating prices to heat your home. Who doesn't want to win that lottery? Much like the government, I feel bad that your costs are rising. So I want to help you out by giving you some free money. It's not a lot. It's only 1 million Zim dollars, but it's something. Well, you can't buy anything with it, but it does look good as wallpaper. And if you live in Europe, you might even be able to use it to heat your home this winter. If the lottery is a tax on people who are bad at math, then inflation is a tax on people who are bad at economics. I want my listeners to be better at economics. So I'm giving my loyal listeners free money. Go to www.moneytreepodcast.com/free money. Follow the instructions to get your free money today. I have a large audience and a limited number of these currencies. So let's make sure we get yours before we run out. Go to www.moneytreepodcast.com/free money. Follow the instructions and get your free money today.
I want to start there. We're going to get into some charts, but any other thoughts before we jump into some charts here, Doug?
Yeah, the last thing you said, I actually saw something earlier today that was really powerful. It kind of separates the division between successful and unsuccessful, and it came down to the way we handle failure. And we're talking about, let's just get everybody ruffled up, but kind of the educational system that we have designed right now. It really has been structured to promote perfection in so many different areas, right? It's all about, well, you better have straight A's and you better never miss a thing if you want to have this leap. And they were arguing that this wasn't necessarily a great foundation for what true successful what can lead to true success. Because let's face it, is there such a thing as perfection in the real world, Kirk? No, there's failure all the time. And it's not necessarily our ability to be perfect. I mean, I think about it's a great analogy for sports. If you're going to play sports, especially a sport where there is a lot of points, right? Whether it might be golf, where there's a lot of shots, or it might be tennis, like I play, and you're asking how my trip went. I went to the International Tennis Hall of Fame in Newport, Rhode Island. Definitely a trip that anybody who appreciates tennis should go check out. But I mean, you're going to have how many points per game that you're going to play, and you're going to lose a lot of points. And the question is, who's going, and you may actually lose a lot of games, but the question is, who's going to be able to come out at least a couple points ahead? And real life analogy kind of comes into this as well. You talk about that self-realization of perfection and mistakes. What sets success apart is not being able to be perfect, versus what being able to be to have failure. It's when you have the failure, how do you overcome that failure and use that to motivate? And successful people know how to take failure and be able to lead that into a successful outcome. And the gentleman was talking about Dave Chappelle, talking about the first time that he ended up on stage, I think it was at the Apollo, he got booed. And he said, you know what? He could go into this two ways. He could go into this thinking, oh my gosh, I stink. I can never do this again. His attitude of it, and this that he stated in the interview, was, I saw this as an opportunity to say, well, that's as bad as it was. Like, I got booed. That's the worst it's going to get. Awesome. This is nothing. I can do this, right? Many people would buckle by that. Be like, I tried it and I stink. What successful people realize is that failure is how do you overcome it and how you train yourself psychologically within the confines of that failure to move on to a better outcome. And I think that's a huge thing too when we look about internally and kind of how we assess things, that I took away from that. The other thing I wanted to say, and I sent you something on this, probably too big to show, but you were talking about the taxes, right? And we talk about how they started. It was in 1913, the first initial income tax was 1% on the lowest threshold, which was you had to earn $20,000 and you were charged 1% tax on that. The top tier was a $500,000 top tax bracket, and the max that they were charged 7%. Now, most people would look at the 500 and say, well, that's not much money back then, but I would also argue that the 20,000 for the average person was a ton of money. And if you look at that, you say, well, gosh, they really didn't implement tax on hardly anybody. But let's go 5 years later. Here we are, World War I, Spanish flu, who knows, all those different variables. But 2016, they went from 1% to 2%. An extra percent on anybody making over the 20. That still may not seem like much, but look at the next year. They went to 2% on 2,000. Boom. How many extra fish do you think they caught in that net, Kirk? A lot. And then 1918, bam, 2 to 6, starting at 4,000. And then look at the brackets and where they went from there. And by 1941, granted, World War II, 10% tax on the lowest tax threshold, which you only had to earn $2,000. Now, $2,000 again doesn't sound like much, but $2,000 in 1941 was a heck of a lot easier to earn than $2,000 in 1917. And it was probably a lot easier to earn than $20,000 in 1916. So all of a sudden, 19, 23, 19, all of a sudden you get into those latter years, the bottom threshold was now getting taxed at 20% on $4,000 in the 1950s. But the top tax tier, look at that, 91%. We hit a max of 91% that carried until 1963, when they finally started to probably get past paying off World War II and started to slowly drop it down. And we started to get, 1980s, we're back to 50% at the top. And look at, our lowest tax years were 1989, 1990. Now, not on the lowest end. It was 15% on the lowest end at $30,000, but it only went up to 28. Here we are sitting at a lowest tax bracket now of 10% on the bottom, 37% on the top. So for anybody, and the reason I'm bringing this up is I think you really have to understand the pattern of taxation here. I think people are very, very, is tax appropriate? I don't know, right? That's a political conversation. Are they spending it right? That's a political conversation. Everybody's got opinions on this. But what I would say is if you look at where they went when they needed money, okay, and how easy it was for the government just to make a simple switch that doesn't seem like much, but gathers a few more fish into the net. And on the volume of Americans, that's a lot of money to the bottom line. And if we look at where we are, as much as people complain about taxes, you have to agree, we are still in some of the lowest tax brackets based on inflated value of income. I mean, 10% on 22,000 in 2023 is a lot different than $20,000 in 1914. And so if we take a look at that and we look at where we went in the trajectory, one thing I think people are woefully underprepared for. Now, yes, the government, why do they need the taxes? They can just keep printing it. But let's face the reality. They want that money. And
Yeah.
if we keep going in this path and we look at history, can we argue that there's a higher probability of taxes going up than going down? No, but they only went a little bit lower than this in the late 80s. And I think that one thing that people just aren't prepared enough for is the preparation. Because I hear this. I don't know about you. I talk to people like who have lived a generation plus of seeing low tax brackets, and they just don't believe that taxes are ever going to go up again. I don't know if they will. I don't know if they won't. But what I do know is based on where we are in terms of money needed for our obligations, and based on where we've been historically, I think people need to spend a little bit more time preparing for what could occur and prepare for taxes going up as opposed to preparing for taxes staying the same or going down. I mean, the history's there.
Yeah, I think it's interesting because I think, if you look at the numbers, you look at like 20%, because that was one of the more recent numbers. I think 20% is probably a fair number just for everybody, right? You pay the government 20%, they have to figure it out, right? I think at the end of the day, the more you spend, you can look at some of these Nordic countries, and they're paying the highest tax brackets, like 95% or something crazy. And it's like there's no incentive to start businesses and to become wealthy. So you tend to not get big businesses there. Like the U.S., we come up with big business all the time. We're very entrepreneurial. We have an incentive structure in the U.S. that rewards failure, right? And I say failure because, yeah, everyone wants to succeed, but our incentive structure rewards failure. If you fail, you file for bankruptcy and you start again. In other countries, if you fail, you file for bankruptcy, you're in jail until you pay that back. In some countries, like, it is not these countries are not set up for entrepreneurs. They're not set up for innovation. This country is. And I think that's something that we have to keep in mind with everything we do, is that, yes, companies like Apple and Microsoft and all these FANG stocks that are like trillion-dollar companies, they should be paying taxes. I mean, let's just call it what it is. They're enormous companies. They should be paying taxes. They're paying 1% tax. That in itself is a problem, right? And why should individuals be paying 60% when they're paying 1%? Right? That to me is just there's something wrong there. But if you think about this in like a bigger picture, like what are we trying to accomplish, right? Like we talked about, and I'm going to take this into the next segment because I want to stop talking about taxes. Is when we're thinking about taxes, right? We want to be able to pay for services, but at the same time, we don't want to overpay. And I think one of the things that we'll find is people have been saying, I've heard this since I've been in the business for 24 years. Oh, taxes are only going up from here. Every single year, taxes can only go up from here. Okay. And I'm making this point because I've heard it over and over again. If anything, taxes have gone down. Right. And now the characterization is, are we talking about taxes? Are we talking about taxes and fees? Because there's always these little side fees. There's always things they don't call taxes, but they're taxing you in other ways, like Obamacare and these other programs. Every time they come out with a,
I want to talk about that in a sec, but go ahead.
Yeah, we can come back to that. So, but the point is the fees are basically a tax, and we need to accommodate for the fact that exists. But the point is we should not necessarily assume taxes are going up. So anytime you're doing tax planning, and this comes up a lot, oh well, I need to pay the taxes now because it's only going to go up later, or I need to do this tax plan that incentivizes now versus later. And it's not necessarily the case. We have to look at history and say, well, if anything, they've gone down a little bit, the taxes part, not the fees. And so if you're thinking about planning strategies, don't just assume that taxes are going up because they have to. We've heard that for 20 years, because they have to. Well, they don't have to, right? And yes, our U.S. government runs on a Mickey Mouse calculator where they come up with imaginary numbers, and no one knows. I mean, I'm sure there's smart people putting the numbers together, but they don't add up in my head. So whatever the methodology of math that they're using is not the right one. But at the end of the day, you have to understand that that what needs to happen in this country is certainly a more transparent and clear system. But if you're doing planning, you just should be open to the fact that there are other scenarios. Now, before you, Doug, I want to kind of go into this one topic here, which is let's let's look at this chart here. And for those of you who are listening, I'm going to explain it. But basically, it just shows the S&P 500, the 3-month Treasury rate, and corporate bonds. And what it's basically showing is the yield. The yield for 3-month Treasuries, the yield for corporate bonds, and the yield for the S&P 500. Now, the S&P 500, it's earnings yield, which is what people calculate is how much they're making on their investments. So historically, the earnings yield on equity is higher, right? You get some dividends, you get some earnings, so it tends to be higher. You're taking more risk, but the benefit is you have higher earnings, right? And that's a huge benefit as an equity investor, is that, yeah, you're taking more risk, but you're getting more benefit. So over the last 10 years, it was right around six up and down, depending on the year, somewhere above, somewhere below, but basically right around 6. Okay, let's say, now this only goes back 10 years. So bear with me, because I know if you go further back, it's different. But let's look at the last 10 years, okay? It's right around a little bit below 6, maybe about 5.5, somewhere thereabouts. Okay, maybe 5.25 is what it looks here. Now, if you look at corporate bonds, it's also right around 5.25, 5.5. You look at 3-month Treasuries. Oh, look at that. It's also right around 5.25, 5.5. So now I'm going to explain what this chart means. So they're all right at the same point in time. Now, what this means to me is if you are investing in the S&P 500, the earnings yield is what you should expect as your quote unquote rate of return, if you will. It's a ballpark. I'm not saying it is. I'm trying to simplify it for listeners. Let's just assume that's the kind of expected return you should kind of look for, okay? And obviously you're taking risk. The stock market could go up, it could go down. But the volatility risk is it could go either way. You don't know if it's going up or down. But you have that as a risk, right? You could lose money, you could make money. But overall, you should be expecting, these are the earnings yield. This is kind of the return I should be expecting with equities. Now, if you look at corporate bonds and treasuries, you look at short-term treasuries, right now they're around 5% to 5.25. Okay, so if I was to invest in, we were just doing some today. So we invest in let's say a 1-year treasury, you're getting about 5.25, a little bit more, a little bit less, but let's say 5.25. Okay, I can make 5.25 from U.S. treasuries. I'm going to be able to make that for the next, I think, year and a half is approximately where that goes out to. Or I can invest in equities and make the same thing. But if I invest in treasuries, at the end, I'm going to get my money back, plus I'm going to get my 5.25%. With the stocks, over 7 to 10 year period, yeah, I'll probably make the 5.25 a year, but next year it could be that the market goes down 20% or 30%, or it might be it goes up 20 or 30. But you don't know. So the reason I'm showing this chart is what it's illustrating is the fact that all of the returns, the expected returns for these assets are effectively the same. So they might be the same, but the risks are not the same. The risk of equity is a lot higher than the fixed income risk. Now, everything has risk, right? Everything. But the risk of fixed income is a lot lower because as long as you hold to maturity, you're going to get the money that you expected, assuming that the government doesn't go bankrupt, right? And the equities, you also have the volatility there. So my point is this is such an important chart. This is what we've been talking about for months. When I said back in earlier this year, I said, start looking at fixed income. Start looking at it. And people, I got a lot of hate mail, what are you talking about? People lose money to inflation, all this. Yeah, but you also lose money to the stock market too. So it's not just inflation. But if you look at this, just take account for the fact that don't write off fixed income. Consider fixed income for your portfolio because sometimes fixed income will give you a better rate of return than the markets. Now, the first half of the year, everybody's like, wow, the markets are great. Oh, let's go back into the markets. Yeah, because we ended up last year at a low point. So it looks good. But realistically, we're only a few percentage points above the range that it was at for the last 2 years. So realistically, it's not a bull market per se. It's a bull market off a point in time, which we talked about last week. And that point in time matters. And at the same time, it has no relevance to anything. Right? It just happens to be a point in time, but everybody looks at it, which is why it's important. So consider why you should add fixed income to your portfolio because it's less volatile. It's more predictable returns. And I'm not saying you shouldn't put equities. Not what I'm saying at all. I'm just saying you should consider the risk to reward of this. Before, there was an incentive. If you look in this chart, pretty much, except for 2017 to 2019, you pretty much had a 0% interest rate for 3-year treasuries, and you had a 5 to 6% yield, earnings yield on the S&P. There's a reason everybody put their money in stocks, because it didn't pay to put your money in fixed income. You took a lot of risk and you didn't get paid for it. So there's you had this policy. There is no they call it TINA. There is no alternative, which is what people were saying to equities. There is no alternative to equities for the past 10 years. Now it's different, right? Now you have to consider TINA no longer applies. Now we're looking at hey, fixed income actually could have some alpha over equities here. So just something to consider. I'm going to let Doug talk a little as well, but there's something to consider for your portfolios. Don't write off fixed income. There's a lot of value to it that I think, when the market's rocketing up, you might not see it because you're thinking, oh, I'm missing out. Don't look at it that way, because you'll find that the equities, I'm going to make a prediction here that today's the last day of the month, that after the 4th, that the stock market's probably going to sag down for a while because it's gone too far too quickly, and that's just not how things work. So I think we'll probably see a bit of a sell-off here after, and who knows where it goes after that, but I think it'll take the wind out of the sails of equities. And then you realize oh, maybe I should be in fixed income. Don't chase the hot dot. Come up with a strategy and stick to it. Go ahead, Doug.
Well, so you're saying sell in July and go away? No, we'll come back. We'll come back to that in here in a second.
It didn't rhyme, so I had to go the May, but that's okay.
Hey, we just got to mold it to fit our narrative here, right? So, if sell in July, now it's instead of selling May, go away till October, we'll sell in July and go away till
find an alibi. There you go.
No, just kidding. No, I was going back to the tax burden. I think that was really interesting because it's something I identified. I think you make a really good point, because there is, a lot of talk. Well, you should put all your money in Roth IRA to pay all the taxes today. There's actually some really smart people who've done some calculations that argue heavily that you should never use Roth IRAs, that they actually end up costing you more than deferral. And there's some math behind it. I'm not going to get into the complexity of that. But if we go back to the add-on of all the taxes, and there's some great information on the tax burden by state that the taxfoundation.org puts out there. Not going to get into that today. It gets a little bit real complex about the economic impact of residents based on taxes. But I will tell you, if we go back to those 1950s and some of those higher taxes there, what was interesting too is that was also around the time and beyond that, the Eisenhower started to push the highways, the major highway initiative. So yes, people were paying a lot more in taxes, but it was also going into a massive expansion of infrastructure, as well as pay off the debt of World War II. And it also went into a lot of things that we take for granted today that are free. One thing I discovered, and you talk about all these other things, there's been a significant increase in the number of areas where that have become non-tax but tax sources for governments and entities. And there's not only government-based, but it's also colleges. As we get into the college cycle of things, especially state colleges, they are continuing to lose tax subsidies from the states. And guess what? They're going and saying, look, we need to increase tuition, and they're being told no. Guess what they're doing? They're going and increasing other areas, extra fees, more for room and board. They're becoming the real estate focus of it. Different things you have to sign up for. On the trip that I was on, one of the things I prepaid for, Kirk, before going on this trip, is Avis allowed me to pay $8 a day to cover tolls. Okay. And so they would cover anything on this trip that I had as a toll station. And guess what? There's a lot of tolls. Once I got basically south of Milwaukee and started to hit 90, going all the way through Ohio, Pittsburgh, and on, and as you know, where you live in Massachusetts, going up into Maine, toll after toll after toll. Free roads are gone. There's the way they get taxes. Revenue taxation has become a big thing. They pass these bonds and then they charge people to use it. So they're no longer bringing in those taxes necessarily and then paying for that. They are now saying, we're going to keep the tax base really, really low here. And we're going to charge through, every year you get your license plate. You're paying you're paying fees on cars. You're paying fees for this. If you want to be able to buy a right to buy a gun, God forbid, in the United States, buy a gun, there might be a fee to have the right to be able to go make that purchase. tolls, etc. So when you start to add in, yeah, I mean, Kirk, it's a great question. Is, again, and should you worry about tax deferral versus paying the taxes today if the tax burden, if the actual income tax isn't going to be going up? Because they're not going to actually assess that, because let's face it, governments like to market, they like to look good. Politics is all about packaging and hiding what you're really intending to do. So income taxes, maybe they keep those low forever because it sounds good, feels good. But guess what? They're going to get their revenue one way or another. Texas, tax-free, no income tax. Guess what? They get you property taxes. Almost every road that you take there is a toll road. I lived in Dallas North Tollway, George Washington. They're all taxed through tolls. Okay, so you're paying. They're just not taken out of your paycheck. If you want to use it, you're going to pay. So I think it's really interesting that, again, and I think it changes the way you have to think about planning, because that is not something that's necessarily going to be accounted into deferral and income tax base. As someone that might be going into retirement, you're going to have to think about in the true economic impact of fees as part of those taxes as well, I think is really important. And then coming back into the thing that you were just showing, the chart you were just showing, what this is called, it is a CFA 101 level stuff. It's called risk-free premium, right? So you're basically looking at, where do I put my money right now to get what's effectively known as a risk-free return? And when you're doing, and this, like I said, this is CFA 101 stuff. Okay. If I can and this is the exact reason the bonds go down when interest rates go up. Because just to educate and think about this for a second, if you have a risk-free premium in a bank account, right? Get it from savings or whatever that might be, and you can put it there with virtually no loss. And let's say you can get 0.5%. That's what the banks are paying you. Well, guess what? That long-term bond that has risk, more risk than your savings account, that's paying you 4%, looks really, really good. Looks really great. I can get 4%. The government's probably not going to default. That's fairly risk-free on it, but there's more risk on that than, say, arguably having your money sitting in cash and getting 0.5%. So you're going to sit there and say, all right, I'm going to go ahead and I'm going to get that 4.5 because I think it's a really low risk, fairly risk-free premium to be able to have my cash there. But if the government starts raising interest rates, and now you can get short-term bonds issued at 5 or 6%, and you're stuck in a 4.5% long-term bond, you've got a lot more risk that thing's going to make it in default over, say, 30 years than getting 5 to 6% on something short-term. People are going to move their money. That's why bond values go down. It's very, very simple. And what you're talking about there with the stock market is the same thing. Now we had the bond values get deflated. Now they're cheaper to buy and their yields have gone up. So you're going to get paid more on that. You're going to get paid more on a short-term bond. Kirk, insurance companies right now are paying fixed accounts at 5%. And I've seen higher than that, right? So you can get 5% with virtually no risk whatsoever. What do you have to get in the stock market, along with all that extra risk right now with valuations which are historically high? What do you have to do to get 5%? Well, you're not going to get 5% off the dividend yield, right? The S&P 500, I don't know what the average dividend yield off of it is. What is it, about 2%, 2.5% all in? So you're going to get 2.5% off of that. But now you got to take, which looked really good, because I know a lot of people are dividend proponents, and nothing wrong with dividends. But anytime you get total returns in stock, it's a combination of the income they give you through dividends and whatever the depreciation is. So you sit there and go, well, I'm not making money in the stock market. That's why the government lowered interest rates, push people out of cash, go invest it, make money in the markets, make 2.5% yield on dividends. And it's great because you look at it and say, yeah, there's some risk, but I'm not making anything on my cash. Well, now you turn around and say, well, I can get 2.5% dividend, but now I've got to make up that extra 2.5% on appreciation in the stock market to match a 5% fixed account on insurance, or like you were saying, a 4 or 5% short-term bond. But stocks don't always go up. So you got to hope 2.5% in the stock market is going to be achieved on a consistent basis. And this is where people get confused about compounding. Like, well, the stock market compounds at this rate. The stock market doesn't compound at all, right? Because appreciation is different than compound interest. Compound interest, here's your money, you keep it, and if you put it there, you get that interest on top of it. It grows, it grows, it grows. If the stock market's going up by 3, 4, 5% a year, that is not compound interest. That's compound appreciation. And as you know, Kirk, and as many people who might be older have learned through the 2008s, 2011, 2015s, 2000 whatevers, it doesn't take much to eviscerate that compound appreciation, right? And all of a sudden, there was no you went from a 5, 6, 7, 8, 9% compound appreciation to all of a sudden a 2% compound appreciation overnight because the market just fell by 50%. Okay.
Yeah.
That's massive risk. The only money that is compoundable is interest. That's what it comes down to. Interest and arguably dividends, but now you got to worry about the appreciation. So what we're talking about here is understanding from CFA 101, what is your risk-free return? And if your risk-free return is a threshold of, say, 4 or 5%, that's where it becomes very dangerous for things that have no guaranteed risk-free return to be in, at least in the short term, because those things, in order to achieve the same risk-free return, have a tremendous amount of risk. And that's why, you start to look at the chart there, this S&P 500 is now matching a similar level of return to what you're starting to see in risk-free return. Why not move your money there? And we're not seeing that money move yet. And I don't know if it will, but it definitely should give people pause as to whether or not their money is in the right place. Because as you said about efficient markets, modern portfolio theory, efficient market theory, efficient market theory, Kirk, got blown up. If it wasn't already blown up before, it got blown up the day high frequency trading came into play, right? When we talk about everybody having the same information, guess what? High frequency traders by mandate have that information faster than you ever will, right? So you don't know when that's going to shift. And that's why if you're going to do any type of basic thought of allocation on where to put your money, start with CFA 101, risk-free premium, and start to think very strongly about your allocation and balance there versus what you have at risk.
Yeah, no, I appreciate that, Doug. So I'm sharing a chart, the historical chart over the last 150 years of the S&P 500's dividend yield. And I point this out because right now, Doug thought it was 2.5, which actually it has been up until the last few years, and it's actually gotten so much lower. Right now, it's about 155, 1.55% dividend yield on the S&P. I actually thought it was higher too. I think it was like in the high ones, but it shrunk. And
I should have known because I've looked at the S&P index funds and dividend funds, and then their yield stinks. And I know they're taking some cost in running those things, but yeah, I'm the old saying, I'm surprised but not shocked.
Yeah. So I mean, think of it this way. When you see, and the reason I want to kind of bring up this chart is this. So if you look here, historically, it's kind of ranged between 1% and a little over 8%. Now, 8% is an anomaly, right? If you look at this, there's spikes, but it's even that one spike is not really realistic. But neither is 1%. 1% was at right around 2000, and right now we're heading down close there. What that should tell you is that the market's expensive, because it should not be 1%. The dividend yield should not be that low. Historically, 3% seems like a reasonable number, and that seems to be where the bottom was up until the 90s and 2000s. So I bring this up because if you don't look at things relative to history and to themselves, you don't realize how far out of the norm you are. So we're accustomed to the last 20 years, like the whole generations of people who have never seen the 70s or 80s and what it was like then. And those are very different times. And we may re-experience that, as we've hypothesized on this show, is that we may re-experience that in a meaningful way. But you need to understand, like during those times, you got a much bigger yield on the S&P 500. And right now it's 1.44 versus getting 5 to 5.25 on your US Treasuries. Huge difference, right? And I'm not talking, and if you use earnings growth, then you can consider that's the total growth. So it's about the same. So I don't want to beat this dead horse, but I did want to point this out in reference to what Doug said, because I think it's really important to look at history. I also want to point out.
One thing is interesting is if you look at the history, and this is a generalization, I don't exactly correct quote, but dividend reinvestment accounts for about 1/3 of the total compounded return of the S&P 500. I know that could give or take a little bit more. What this new data shows, and this is another reason to be very concerned, if historically the S&P 500 has had its return enhanced by 1/3 of it being dividends, which again is a risk-free premium, right? It's telling you now that the dividends are this low, how much more of that return is subject to pure speculation, and growth and appreciation. Not necessarily speculation per se, but just the appreciation of those stocks. And it goes away from the historic balancer that was a factor in the long-term return. So just a thought.
Yeah, so I want to wrap it up with a few charts, and then I'll let Doug wrap it up as well. So I want to share a few charts here because we talk about on the show and how credit card debt is going through the roof, and all these statistics. So I actually wanted to pull up a more historical chart. So this is the personal savings rate. This is what the Federal Reserve puts out. This is the personal savings rate. It's low, but it's actually creeping up a little bit recently, which means people are saving more. But when it gets low, it's a real problem. But if you look here, it spiked up when people got free money, right? Because they could save it, and then it spiked down. That is a normal volatile range because people will generally, if you get more, they'll spend it and they'll spend more than they have, and then they'll be lower. So it is creeping back up. But I think when you hear stuff in the news, you hear, oh my God, people aren't saving. Like it's actually creeping up a little bit. So just keep that in mind. The next one, consumer debt service payments as a percentage of disposable personal income. What this means is how much of your disposable income is going towards paying consumer debt. Now, if you look here, it was actually a really low percentage in 2010, low percentage 2020, and now it's kind of back to the higher end of the range, but not where it was in the early 2000s. So just for a reference point, I'm using this, and you can, if you're listening to the show, you can certainly go to YouTube or you can go to the website, you can see these, but it just kind of puts things into reference. The next one is the delinquency rate on credit card loans. So it's picking up a little bit, but it's still really low. So you would imagine, given all the money that people are putting on credit cards, eventually they're going to default. It hasn't really happened yet. It's started to pick up a little bit, but it's not really to the same degree. I will point out some of the information that I've heard recently talked about that, we do a lot with private mortgages, and some of the rates that we're looking at are people are just starting to default on some of their mortgage debt as an investor debt, not personal. We don't really deal with personal, but investor debt, like we're starting to see that people are starting to default, just starting, which means if you look at 2005, that was the peak of the real estate bubble and went down for the next 5 years. And we're in year one. And I'm assuming that real estate prices are going down this year because last year they went up 10%, the median home price. So if they go down, this is the first year, we could have another 4 years to go, which means that we're just starting to see some of the data come to pass. Now, everyone I know, all the smartest people I know when it comes to investing in finance are saying the same thing. Where's the recession? Where is it? We're not seeing any data that's supporting a recession. Everyone's talking about it. Everyone feels like it should happen. Where is it? The next point that usually comes up in the conversation is, I don't trust government data anymore. It doesn't make any sense. Now, I'm not going to be a conspiracy theorist, even though I'm wearing my 4th of July shirt, even though it's a Philadelphia shirt, by the way. Some people gave me dirty looks because it was American flag. But I'll put on my tinfoil hat, I'll wear my American flag, and I'm going to talk about the conspiracy theory of government data being erroneous. I don't know if that's true or not. I'm not smart enough. I've talked to people who said, yes, it is absolutely managed. I think it'd be hard pressed to say it's not managed. I think everything is managed, but whether it's completely fabricated or not, I don't know. I know we yell at China for having bad data all the time, and yet we're doing it too. So, I don't want to throw stones. We're in a glass house, but we should keep in mind the fact that, if you're just looking at economic data, then you're not getting the full picture. You also need to look at data that comes that comes from more, I guess, organic sources, right? Like what's going on in the retail environment? What's the consumer sentiment? and I don't mean consumer sentiment data. I mean actually like just there was a friend of mine who's a really good investor. And he says he likes to travel because every time he travels, he talks to the cabbies, talks to the shoe shine boys, talks to the stewardesses, talks to everybody, and just getting a sense of like what's going on. What are people talking about? Are people down? Are they spending money? Are they not spending money? Is so they get like a sense of like an organic what's going on. It's like going into a store and saying, "Hey, how's traffic? You guys busy? Not busy?" Getting those, and this is what Peter Lynch used to talk about, like going to a store and see what people are saying, like is there feedback? And this is how he made a lot of his great investment decisions. It wasn't from watching CNBC. I think it's a great way to lose money if you do that. But if you go into like this organic approach and just get a sense of like who's buying it, what's hot, what's not, go on these, go on forums, go in these groups and just hear what people are saying, like organically. And you're going to get a better sense of what's going on in the world than just the government data. So if you don't trust it, like I do right now, I think it's questionable. Get a sense from other people. So at the end of the day, it doesn't matter what the government data says. Doesn't matter what people say. What matters is the price. So if the market's going up, people think that it should go up. If it's going down, people think it should go down. That's the only reason you're going to make and lose money in the market anyway. And I'm not discounting fundamental investing. I'm just saying that at the end of the day, price is what matters. You could be right for 10 years and the price doesn't go anywhere. What that equals is you're wrong. So it doesn't matter what the fundamentals say. The last chart I'm going to share, and I'm going to leave it over to Doug to wrap us up, is the farmland index, NCREIF Farmland Property Index annual returns. And what this chart shows is basically for the last 20 some odd years, what the index annual returns are for farmland. Now we talk about farmland. I saw this chart and I figured I want to share this as a pretty good chart. So what it shows is the appreciation. So on the left side, it's the appreciation. The blue is appreciation. The income is green. So it shows the income is generally pretty standard. It's somewhere between 5 and 10% historically, and then the appreciation it comes and it goes. Some years it's there, some years it's not. 2005 is a big year. It's starting to creep up. Appreciation, we're starting to get it. But the point is, if you look at this chart, you'll see the total returns for farmland is pretty good over the last 20 some odd years, right? There's definitely some times where there's some 2001 where there's some appreciation was negative, but generally speaking, you're getting a pretty good consistency. Now, I will say that this is looking at institutional farmland. This is not retail space. I'm not telling everybody to go out and buy farmland. I'm just saying historically, you should understand how farmland looks because almost nobody tracks this stuff. Nobody talks about it. No one's going to show you a chart on CNBC. It's not something that's talked about. We do talk about it in the show. I know we've had some calls like, hey, find me someone who does farmland investing. We can do that. However, I will tell you that everybody I've talked to recently said, we don't have anything. Everything's too expensive. So keep in mind that just because you want something doesn't mean you should go out and buy it. It could be that it's really expensive and you just need to wait. So just be mindful of that because that is what we've been hearing lately is like, yeah, it's great, but we got nothing in our funds. Like we can go out and buy stuff, but it's going to be too expensive. So we're not buying it. I've heard that from multiple people. So just keep that in mind. So Doug, you want to wrap it up here and get us onto this weekend so we can start drinking our American beer with American flags and shoot some guns in the backyard and do all the other American things, cook hot dogs and burgers.
That's great. Listen, I could keep us going I'm going to have to run through. I'm just scratching the list. Put that foil back on for a second. I want you to. So couple of things there. You talked about, the government and all the data they're telling you. Listen, here's a perfect example over the last 2 weeks, 3 weeks of this. And just keep this in mind. The sub that imploded. Okay. The news came out that they lost the sub and they've got 48 hours or 72 hours of oxygen available that they were going to. The government, the Coast Guard said they'd heard an explosion, knew that it imploded within hours, okay, of when it went down. And yet they still let everybody believe for like a week that these people were still there and had enough oxygen to live. The government knew, once again, they don't always let you know all the information that they know. Now, wait, and for like 40, 50 years, they were telling us we didn't have aliens. Now that, and they said they lied, but now that everybody doesn't believe they're aliens and the government's now coming out and telling us that they found an alien. Look, there's always going to be a story there.
Doug, is that hat made out of tinfoil? Because I should pass this on to you. I think
this is real facts. The government's come out and said it recently. I'm not telling you whether it was right or not. I'm just telling you that there's always going to be more to the story. You talked about it doesn't make sense. I want to make a joke on that. It's because of inflation. It now makes dollars. But I did want you to go back to your chart there about the uptick in debt really quickly, if you can pull that up here. One thing to note, the pattern there, and again, this doesn't go back forever. And as we always say, causation and correlation are, completely different things. But if you look at that, not that one, it was the other one. Nope. Oh, maybe this was it. Yeah. So if you notice there that I think the beginning of the chart I can't see, but you notice it dipped, it started to come back, and it actually did not go into recession on that uptick. But if you look at every other uptick that started to uptick on that chart, guess what it eventually led into? Recession. So I think that's, here we are, we are seeing that uptick, and probably one of the most sizable upticks without recession that we've seen. Just be aware that could be a leading indicator. You talk about Peter Lynch and going in and seeing how, people are acting. I think this is also why, forget what they're telling you. Consumer sentiment indicators, I think, are really powerful indicators. Like you said, if people think the stock market's going up, they're going to keep investing in the stock market. If consumers are happy, if consumers think things are good, they're going to, more likely to spend or invest without without worry. And lastly, kind of talking about the farmland. Okay. A couple of things I saw there. You notice how the income kind of stayed steady. That's because one of the few true commodities we have in the United States is food, right? It goes commodity. Corn's the same price no matter who's selling corn, unless you can somehow come up with a super sweet brand on it. But also thinking, again, putting that, tin hat back on. Some people would argue the reason farmland's going up is because Bill Gates is buying all of it. But I think it also, kind of goes into, a way of don't know necessarily about those valuations, who's investing in it, what those values are, what that data is. Reminds me a little bit of Omega watches. There's a long time they used to say that, watches were one of those investments that always appreciated, buy a good watch. Well, then it came out that Omega was was going out, and they were the ones that were bidding up the value of watches and building up their value of watches in order to keep the watch industry appreciating. So, it's always interesting to see kind of what the data behind the data is, what's going on with that industry. I will say, it is evident, farmland is one of those things. As food inflation has gone up, you're definitely seeing the investment in something that has a long stability. We need food. We need to produce more of it. So I think for the time being, that has definitely been of interest. Last thing I want to say, and I don't know if you saw this, Kirk, but there is a very interesting battle going on right now between the mortgage industry and builders. I was starting to read some data that came out that with the spike in mortgages, that is, the fear of what would that do to new builds. It turns out that some of the builders are actually out there bypassing the mortgage industry and offering their own basically builder finance options. And they're offering these at like 4.5%, 5% under what mortgage lenders are lending to. It's kind of helping to, at least for the time being, potentially stabilize and promote buying a new build versus buying an existing home. And so the new builders have been having a fair amount of success in this, being the direct lender to the buyers of their new homes. So it's going to be interesting to see how long they do that, and how that battle between mortgage rates and their lending, and what that's going to do to, again, the ability to see the demand stay high for homes, and the shift from existing homes potentially to more new builds, and keeping that market up. So you can take the foil off now. Just a couple of things, the data we can always talk about a little bit more at a follow-up. Listen, as we talk about costs, again, it is July is coming up here. This is the beginning of the college funding season. Okay, this is when things really kick up again. Families are starting to look. Their kids are going to be going into the senior year, and this is when they start to get worried and want to, really want to begin to think about what are we going to do about the cost of college. So listen, we're going to be putting some new information out. Go to our website, ProCollegePlanners.com. Download our key money checklist about the main things you need to know going into the college planning world. Some really valuable information. It's free. Again, it's ProCollegePlanners.com. And again, if you want to get some more information, join one of our upcoming webinars. We'll be putting some information out here, as well as just reach out to us with any questions. We'll be happy to answer any concerns you might have. ProCollegePlanners.com.
Awesome. Well, thanks for joining us, Doug. And as we kind of wrap it up here, I'm going to leave you with one final point, and hopefully Doug doesn't join in because we got to wrap it up. We're already way over time. I do want to point out there's one other thing to think about is when you look at what happened out of Russia last week, and I wish we had talked about this in the show last week, but we had the head of the Wagner Group supposedly was going to revolt, and I point this out because to me the whole situation was odd. The whole thing was odd. Like it was odd, like what happened. It was odd, like I look at it as fog of war. Nobody really knows what's going on. Everyone seems to have an opinion of exactly what happened. I don't know. Did he send a letter to the media and say exactly what happened? To me, it just seems like it was more like, I don't want to say PR, but it was more like a feint with Putin just trying to ruffle people's feathers or do something. It's just nothing added up. So when you see stuff like this, when you see news that just says that doesn't make any sense, it should give you pause. It should give you pause to say this doesn't make any sense, which means it's probably incorrect. Whatever's being said is probably wrong. And, it could be right, but the probability is it's incorrect. Did a guy really just try to march on Moscow and take over the Russian government and then turn back for no reason whatsoever? Just the whole thing just smelled weird. Kind of like Putin blowing up his own pipeline. Something like that just seems a little weird. Oh, he blew up his own thing and wanted to blame it on us. Like the whole thing just stinks. So anyway, I just kind of leave you with that. Is anytime you see something news that just says that doesn't make any sense, there's probably a reason for it. It's probably incorrect. So anyway, I want to wrap it up here. Happy holidays, everybody. Hope you all have a good Independence Day. Spend time with the family. Spend time doing things you enjoy. If those things don't align, then spend time with your friends. Sometimes you don't want to spend time with your family, but either way, take time off, spend time with friends and family, do things you love, be outside, enjoy the summer. This is one of the best times of year to do that. So thanks everyone for joining us this week.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.